And we're live. Hey, everyone. We've got a little bit of a problem today. Not a problem, but a little bit of a delay. Richard is stuck in traffic, and he is on his way to the hotel. He's in Barcelona today, so he's going to be a few minutes late. So that's fine. So you can hang out with me. But I just got over a cough, so a little bit of a cold. So I've got a bit of a cough. So if I'm coughing from time to time, please excuse me. Let me just see here. Can everybody hear me so far? Gianandrea from Italy. That's good to have you. Luke, yes, nice to see you there. Great. Got some of the regulars on. Please just let me know if you can hear me okay. I'm in a different location today, so I want to make sure everything is set up all right. Okay, thanks, Mohammed. Thank you. Great. Okay, so what we'll do today, hey there, Charles. Oh, from Singapore. Nice. You know, Singapore is one of the places I've never been to, and I always meant, but every time it seemed I was going to go there, something happened. So one of these days I will get there. Dennis from Munich. Great. Good. Oh, we got the Dutch contingent with us here. Wonderful. Great. So we're probably going to switch things up a little bit today. Maybe what we'll do is I'll just get started. We're going to wait for Richard, no problem. And this is actually a presentation that if I would have known you'd been late, I would have just taken over and done it. But this is something that really Richard does specifically, and he was going to just basically share a screen and show you exactly what he does. And well, here, let me just show you on the slide here. It's basically earning high interest on Deribit. And the interest is going to depend on which futures contract we choose. And it's a very interesting way of earning money. I don't want to say it's guaranteed because nothing's guaranteed in life, but the only trick is exiting the trade and being aware of fees and things like that, which it's very interesting. It's very lucrative. And I think for a lot of people here, especially judging by the comments we've had in the past, there's a lot of pretty savvy, a lot of you are pretty savvy, and this is not a difficult thing, but it does require some focus during execution time, whether you're doing it weekly, monthly, so it can be once a year you do it. It's really not a big deal, or it could be every week. So what we'll do is we're just going to change up the format a little bit. I'll stop sharing the slides, and what I'll do is I'll just go straight into what I have going on in the market, which isn't a heck of a lot because there hasn't been a hell of a lot going on lately. And we'll just continue to wait for Richard. And if he's still not with us by the time I'm finished, then what we can do is we can just ask some questions. If you guys have any questions for me, again, I am not, I trade more positionally. I take advantage of situations. I usually put on single strategies at a time, versus what Richard's doing, where he's systematically trading and constantly delta hedging. No, I do delta hedge, but I don't do it religiously, and I don't always do it to zero. A lot of times I'll let my hedge get out of whack one way or the other if I have a bias. So if we've had a big run up and I think there's going to be a retracement, I'll let my delta go negative in order to accelerate my P&L or my equity. If there's a pullback, and that's what happened last week. I made some good money last week on that big move up and then the big move down. So yeah, I'm happy to answer any questions. Okay. Yeah, sorry. Tell you what, let me just share the screen. We'll talk about what I have going on. If Richard's not with us, then we'll answer some questions. And until then, we'll just kill some time and hang out. Why not, right? Okay, let me share my screen here. Do tab. And I assume everyone can see my silly chart, my ETH silly chart. Well, I'll start over on Bitcoin. Something happened with I use these trading view charts, and something happened this morning, and I wasn't able to put text on it for some reason. So my silly chart title's gone away. But as you can see, I still don't have any positions in Bitcoin. I haven't had any for a little while. I unwound everything. And, look, I mean, we've got nothing going on. We're stuck in this box, this pink box. This is an area of heavy resistance. very similar to the Ethereum chart. And, you know, it could continue to go sideways for who knows how long, right? Who knows what the market will do. If it comes off, I think we might come off quite nicely. We can see we've had some wicks down, which scared the pants off of a few people, or people got heavily short and went right back up in the range. But if we break down from here, I think we're going to come back down. The thing is if this creeps up and then if this ends up turning into support, then I think we're just going to keep going up. I'd be, you know, I'll bet on that any day of the week. So if we get these prices getting up above here and it's holding the top of this range, then I think the next move would probably be up. And that's why I've got the unicorn up there, because we'll be able to take some action and make some money. If it wants to hold in the range, yes, we could sell iron condors, or we could set up one side at a time. So what I like to do, so for example, let me zoom in a little bit here. If we get a spike up to the top of the range, I am going to automatically, I'm contrarian trader, I'm automatically going to make the assumption that it's going to get rejected off of there. Even if it eventually breaks it, it'll usually get rejected off there once. I'm happy to sell a spread up here or take some puts long at the top of that range. So I'll build a spread up here if it comes up. When it comes back to the bottom of the channel, I'll close the call spread and I might put a put spread on. So I'm playing each side of the channel as it moves one side to the other with spreads. And I'll just say spreads and not naked, just so everyone stays safe, just in case you're wrong, versus putting on an iron condor when it's right in the middle. Because when it's right in the middle, the premiums aren't good on either side, especially now with low vol, right? With low volatility. We're not getting great premiums, so I'm not really interested in sticking my neck out, and that's why I haven't done here in Bitcoin. But if Bitcoin, it could pop up to, you know, 32,000-ish, I'll probably be looking to sell some call spreads up there in anticipation of a pullback. If it doesn't work out, I'll manage the call spread. That's no problem. It's limited risk. And then if it comes back down to the bottom of the range, 30,000 after a move up, then I'm perfectly happy to sell a put spread, thinking that it'll at least cling there for some period of time. That's how I would play that. And I have got no problem buying puts if it gets up the top of the range in anticipation of it coming back at least to the middle of this range. Okay, let's go over to ETH. And actually, I was out. We had a little dinner and talk last night here at a club in Andorra, and one of the women there who's a trader, she watches, and she said, "I don't like when you call it silly chart, because charting isn't silly." Because, you know, she's really into technical analysis. Just to be clear, I don't call it a silly chart because I think charting is silly. I call it my silly chart because all I have is a couple of lines on there. As I've mentioned before, I do have technical analysis training, and I use more technical analysis, but I like to show how simple things can be from a technical long range, high view perspective when you're selling options. Because when we're selling options, we don't need to be precise like when we're buying options. It's like horseshoes and hand grenades, right? We just have to be close. That's what I love selling options for passive income. Anyways, so what do I have? Look, all these X's, these are all these positions I've taken out. I've closed them all. Every single one of these, well, except for the long calls, I'm not actually sure why I had those. It might have been left over an old order, or maybe I was planning on selling some calls against it. But anyways, those are closed out. Everything was really nice profit. All of these positions, typically, if it's a covered call, and sometimes if it's a naked call, but a covered call, when the delta gets below 10, I'm going to cover that position. There's no point in me holding. If I sell a 30 delta call and now, you know, the delta is 8, I've extracted almost all the premium out of it. Why keep the risk there? If there's some black swan event, why have that risk? I've taken out, you know, 90% or more. I just close it. So these have all just been covered. This is not supposed to be there. Get rid of that. Now, I did put on some August 4th expiry, 2,200 calls. You can see this little line goes out to about the 4th. And I do have some 1,700 puts. Again, I'm not sure why I did that necessarily. It could have been part of a different strategy, but I've got no problem hanging on to those right now. It was the end of August, and what I'll do is on the next down move, and they're long. Those are long puts. On the next down move, I'll sell some puts against those to make some of that money back. Now, these puts are, maybe they're a little bit negative ROI, not a lot. Typically with long positions, I close my long positions if they go 50% against me, because what it's telling me at that point is that I was wrong. Because when you're long an option, you have to be right in both direction and timing. So if I didn't get the direction right or I didn't get the timing right, I'd just rather clear the thing off and wait for the next opportunity. Again, I don't buy options that much. Now, last week when I made all that good money, we had this big move up, and I was like, I don't believe it for a second. I bought a bunch of puts at the money or close to the money puts. I think there were 2,000. I can't remember what it was. But anyways, and I took them all out at 80%, 100%, 180% ROI, whatever it was. That was like, I think, on last week's call. I've got no problem with that. And those were next day expiry. Okay, so that was in the evening, and those expired the next morning. I bought those puts, super high gamma. Those are long gamma trades, and I love those trades. Now, I will say that I actually took, oh, no, sorry. You know what? Maybe it was here. Maybe it was here I made all that good money. It was. My apologies, because it came back down and we had a big move up again. Or maybe it was. It doesn't matter. But the point is, what I'm trying to say is I did it again. On the next move, I bought those puts, and the thing didn't retrace. It was about, 2 hours into the trade. It kept pushing up. Not a lot. But the premium, the price was about getting close to 50% against me. I just took it out. Did it retrace? Yeah, it did retrace a bit, but I don't care, because I'm not risking a lot with those trades. Obviously, those options are really cheap because there's no time value built in. It's just, extrinsic value and just a little bit of time value sort of expiring the same day or next day. So I've got no problem taking those out cheap because the risk to reward ratio is huge. A lot of times I'm looking for 200% or more. It just depends on the move and the strikes I got. So as we all know, options can move really fast against you when you've got that high gamma. So that's what I have going on. And so next week, what I'll do is I'll clear all these X ones out, and if I have any new positions. Now, I think we do have a number today. I can't remember. It's not a big, maybe it's unemployment or something not big. This is obviously for the traditional markets, TradFi. Whether it'll affect crypto is probably pretty unlikely. But we do have an FOMC meeting, and I think I put in a poll here. Oh, I did. Let me publish the poll. So I'd like to know from everyone here, what impact do you think the FOMC next week is going to have, and obviously on the crypto market? Do you think we're going to go up, down, sideways? I know a lot of people, I've been hearing some chatter, are expecting a big move up. I don't know why they're thinking that, but they have been. So I'm completely agnostic regarding this. I don't know. I don't feel that there's any compelling reason for the market to move. So, it's just interesting to see what you think. So right now our poll is saying, half people are saying sideways, up, down. Okay. So let's just say this. Okay. Let's just say that FOMC meeting comes out. Maybe there's a little bit of wiggle room, but really nothing. When we look at, the Bitcoin chart, for example, if we're stuck in this range, and actually, let me just go back to my chart here. If the FOMC comes out and we're just farting around in this range where it's holding, what's your strategy going to be? I'd like to hear what you guys are doing, or what you think would be a good strategy to play if indeed this thing does go sideways. Most people are saying, 63% right now are saying we're going sideways, 18% up, 18% down. So it seems like a consensus is, there's going to be a whole lot of nothing, which I tend to agree with. There's got to be some compelling reason, right? We're in the summer, people are on holidays. I don't know. Traditionally, over all these decades, the summers when, not much happens. Crypto's a little bit different animal. I get that. But If people want to put anything into the chat, I'm perfectly happy to chat about this. All right, let's see here. Okay, so please put in any information you want. If you want to talk about the strategy you are going to use around the FOMC, let's talk about that, and we can break down what that strategy entails. The good, the bad, and the ugly of it, because there's never any guarantees, right? We don't know what's going to happen. But so let's see, Def, you said you screwed it up nicely last week. I'm not sure what you mean. I guess maybe on that big move up. I don't know what you did. Maybe you thought that was the big breakout and you went long. I'm not sure. You probably weren't alone if that's the case. But Def says, can you set up spreads at all or nothing as execution, or do you have to step into positions one by one? That's a good question, because I don't get sophisticated when let me just take a look at the options chain here and the order book. So if I go in, yeah, no, I don't think for options we can do it. I'm just seeing if there's any update on Deribit. I mean, we can do IV, of course. So good to cancel, filler killed, immediate or cancel. And they have the good till day. So no, all or nothing. They don't seem to have that functionality in the options order box. Tom, how do you manage the call spread if you don't get a retracement? Simply close it. Well, that's a good idea. It just depends. So, for example, if let's say Bitcoin went up here, and we had this move up to the top of this range, and I sold a call spread up here, let's say up near the unicorn, and it held up here. It just started holding along this line. As I said, if it holds up there, I've got a pretty good feeling it's probably going to end up being a base of support. That doesn't mean it's going to go, in the next hour. It could be another month before it actually makes another move up. Who knows? So if I sold this call spread a week out, I'm just going to hold it. It hasn't breached my short strike, but there hasn't been a retracement. Time decay is going to be super fast on that. So I think that if it can stick around there for at least a few days, I'll be able to get out. Maybe I'll collect half the premium that I sold it for or something. No problem. I've got absolutely no problem with that. If it was a longer dated, if I was selling 30 days out or maybe 50 days out or something like that, I'd watch it a little bit more carefully, because of course the problem with crypto is that unlike, in traditional markets, you can have a gap up, of course, or a gap down. But, while you're sleeping, it can move against you, and that sucks. You wake up and, you're deep in the money, and it's harder to roll it. It's a real pain in the butt. I could consider rolling it at that time. Would I just close it? I usually don't. Tom. And maybe sometimes I should, but I like to let time decay just work for me, because I know I'm never always, I'm never going to be right all the time. So I'm happy to say, all right, well, we didn't get a retracement now. Well, what if the retracement comes in 3 days? Or I'll just wait it out in time. So that's how I approach it. George, does this guy, I assume you're meaning me, Shane, this guy have a YouTube channel? Yes, we do. It's Rogue Trader Academy. Let's see. That's in Q&A. Tom, would you sell a put spread against at that point? Yes, maybe. And so we've talked a lot about delta hedging. And okay, so let's say I sell a call spread or a naked call or something, and I've got a lot of negative delta going on there, and I'm starting to worry. It's starting to press up against me. Well, of course, I usually hedge with futures, but sometimes if I'm thinking, well, you know what, we're still kind of farting around this range area, I'm perfectly happy to hedge with some puts. So I'll just sell some puts, and that might be done, or typically done, as a put spread. So maybe I'll sell some 20 delta puts and buy, the 5 or the 10. So if I bought the 10, then I'd have 10 delta. So I'd take 10 delta off that. So I manage it a little bit using other options versus just the futures. I do that all the time. Now, If I thought that it was just going to fart in the range or come back down, I probably wouldn't do the put spread. But if I felt this thing's going to keep ratcheting it up and I'm going to have to keep managing that call spread, I'm more than happy to sell put spreads all the way up. Okay. Because the danger to me is that if it comes up here, call spread, it's threatening to go up, threatening to go up, threatening. It's not. You know, there's a good chance we're going to come back down to the channel. I saw some put spreads here. Oh, then I've got to manage those, and I can't stand managing put spreads or naked puts. I don't like it. You know, they're tougher to do. I'd rather not have that headache. I'd rather just have futures, you know, as a hedge, because I can just get out of them super easy, in and out quick. You know, you can put limit orders in or stop market orders and just get out of the hedge that way. So I am perfectly happy to do that. It's a funny thing because a lot of people will trade this range differently. If it goes sideways for 3 months, you know, let's say we're at the beginning of October and the darn thing is still stuck in the channel, you look back and you say, oh, why didn't I sell premium on both sides? It would have like been a moneymaker. Yeah, sure, it's not high IV, but you could have made steady money the whole time. But you know, we don't know what we don't know. A lot of people will just sit on that and they say, I'm not doing a darn thing while it's stuck in the range, and they're going to play the breakout. So they'll just put their stop orders up here, the stop market orders, and they're going to go long. They're going to go long the futures, or they'll buy a series of calls and puts, strangles, at different dates out, because we don't, you know, it's going to go in 2 days, it's going to go in 2 months. We don't know, right? So you want to stagger this out. And the problem with doing that, of course, is you can burn through a lot of cash by buying options and waiting months for it to do something. And if it doesn't do it with enough vigor by the time it makes the move you want, if you're getting close to the end of expiry, you know, the thing is 90%, you know, against you. It needs to make a big move for you to make your money. And that's why I'm not a super fan of doing that. What I will do, though, is I'll buy debit spreads instead. So if I'm going to play the breakout saying, hey, you know what, I think this thing might go down or up from this, and I'm going to be ready for it, well, I'll buy, you know, the 32,000 call. I'll buy the 29,000 put, whatever I'm doing, but I'll also sell the 27,000, or I'll sell the 35,000. So at least I'm reducing that cost of that long. Yes, I'm capping my profits, but is the breakout going to happen? And is it going to go all the way back down to 25 in the time period that before my expiry? Probably not. So I'd rather play it a little bit safe, reduce the cost, and if it doesn't go, it doesn't go. You know, you lost a bit of money. Or if you're playing that game and you want to play the long game, well, at least sell a little bit of premium, even short dated stuff. Maybe you're selling 3 days out or 4 days out, just to earn a little bit of theta decay in order to fund those operations. It's a little bit of a dangerous game, but at least if you have to manage it, it's just a short expiry and you've got, you know, very little time left in it and very little time decay, and you can quickly manage it and move on. You got to be sitting in front of a computer. If you've got a day job, you know, that's a little tougher to manage. You know, if you're looking at your smartphone once a day or something, a little tougher to do. I'd probably go a little longer dated, just so you didn't have the headache. But that's my thoughts. So let me move my mouse over here. Put spread. So Luke, what is the date expiration you envision to enter into a position, and why? Well, it depends on what's happening. So right now, if looking at this Bitcoin chart, and I don't know if you're talking about if I'm earning theta, if I'm short options, if I'm selling spreads or an iron condor or something, I'm going to keep it pretty short dated. IV's too low, and this thing could bust out at any time, and I don't want to get caught on either side in a crunch. So I might be selling it weekly. No problem at all. But I'll usually wait for a little bit of move before I sell it. So let's say, you know, Bitcoin, you know, pops up to 31,000. It's not a big move, it's a little bit of a move, but the premiums will get pumped up, and then maybe I'll sell the 32, 33 spread, something like that. That's how I do it. So in this environment, I'm not sticking my neck out long term at all for anything on the short side. Now, if one is to think that because IV is low, it's only going to go up, and it might, it could continue to go sideways or go down. then that's probably a good time to buy some longer dated to expiration. You'd be buying 60 days out, 90 days out, whatever. Or even more treat it like a leap. If you're buying December's or into next year. And the idea is, let's say I think that, hey, by the end of this year, I think we could be at 35 to 40,000. Okay, well, maybe I'll buy some 33,000 calls or 35,000 calls or something, but I will sell calls against that on the way up to finance them. So because Bitcoin and crypto, typically the IVs expand even when the darn thing goes up versus equities, where it usually only expands when it goes down. You can play that game a little bit easier on the upside. Same thing on the downside. I think, you know what? I think this thing will be back down around 25,000 in a few months. Fine. You know, I've got no problem buying those longer dated puts, which have low IV, looks nice, and they look cheap. You know, they look really, really cheap. Let's face it. They're not going to have a lot of time decay. And the next, you know, leading up to that period of time, I will sell puts against it to finance that. So it's always nice to buy puts. And another thing I'll mention too, if we get some stupid move up, like for example, this move up, like just ridiculous, right? Went from 25 to 31 fast, right? Really, really fast. Well, what a great time to buy some puts. Now, those puts might not work out. You know, you're buying some 27,000 or 28 or 20, whatever they are. They're dirt cheap. This few is heavy on the call side. Why not buy them? And even if they sit in your account and rot and go to nothing, you don't do a damn thing with them. Let's say this thing just kept going up and up and up all the way to the unicorn. Oh, well, you paid next to nothing for them. But if it does reverse, wonderful. Even if it doesn't fully reverse, comes down and threatens and farts around, I'll sell calls because I've got my cover built in place. So anytime anything gets cheap in price or IV, and you know, some people think in IV, some people think in price, it's just a great time to pick them up on fire sale and use them in the future. Now, short dated ones, you know, not much you can do with them. But you know, if we had a big move tomorrow, you know, sure, I'll be buying some October, November's, maybe some December's. You know, those aren't going to be affected as much in price because they're further out in time. But you can always find a way to use them in the future and build them into spreads, right? Different types of spreads. Michael, when you previously said sell high IV, buy low IV, those low and high or relative terms can be expressed in any concrete numbers. Well, that's a very good question. So if I'm looking at I'm looking at the Vol index right now. We're at 42.18 in ETH and Bitcoin, you know, 41.39. We're just off the absolute lows. So, you know, traditional stock market, you know, anything sort of south of 20%, you're in the teens is considered low IV. You should be long IV. Again, who knows when it'll go up. Some people have a rule, if it doesn't go above 50% IV in equity markets, they're not selling. Okay, fine. Our research has showed that you should still make money in lower IV environments, but am I going to be selling, you know, 12% IV in equities? No way. You know, we're used to crypto being up, you know, 60, 70, 80, 90, 100, you know, crazy IV, right? So as it's come down, it's just kind of sitting here. I guess this is what I consider low IV. Those are my numbers. You know, if we have any pop up above 50% right now, we get any strikes that go up to 50%, I think that would be a great opportunity to sell IV at that point in time. Could we continue turning up? Yeah, we could. Who knows? But you know, gosh, we're low in relative terms for what crypto is. Hang on, I think I got a message. Yeah. Richard should be joining us in about 10 minutes. I guess he had a problem in Barcelona with a hotel. That's fine. So that's where my IV numbers are. Let me just here go to. I don't know if everybody knows. Why don't I see this? Chrome tab screen. Here it is. If anybody doesn't know, on Deribit, if you go up to these dots up here, these 9 dots, if you can look at the volatility index. This is the daily, and you can look at either Bitcoin and Ethereum, and you can see what it's done for this year. I mean, someone said, and I think I mentioned this on last week's call. It was probably right around this time here. We had a couple of candles up. Someone said the trend is clearly broken. let's go long IV. I'm like, I don't know, that's just a couple of up candles, man. That's not a broken trend. And sure enough, we're right back down. We're sitting here. Could IV go lower? Absolutely. And it might. 35, 30 IV might be our new normal. I don't know. It's pretty crazy. But anyways, that's what you can look at. And if we take a look at the, hang on, let's go back to options. Let's look at trading tools. Look at the volatility surface. It's pretty boring. I mean, look at it. This is like the most boring volatility surface I've ever seen in my life, right? It looks like a kid's water slide. So, usually we're seeing this like a big, on the short-term expiry, got this big spike up on one side or the other. And this is pretty gentle. As usual with crypto, it's skewed to the call side because everybody's generally bullish on crypto. I guess most people are hodlers out there. But, there's not a lot of good stuff to trade. Now, we've looked way, way, way at the back here. I mean, March 29th, 2024, we've got this high IV way over here. So it's way at the back here. We're 70-something%, right? We're like 72%. So, but that's a year out. If by December, the crypto market's gone crazy, that 70 IV is going to be a lot higher, right? So it's all relative. Let me go back to my my chart here. Did we get any questions here? Let me just check and see if we had any. Lewis, the 3D chart. Let me go back there, and I will explain that. So the volatility surface is just a graphical representation of all the strikes. So if I was to look at every strike starting from tomorrow out for a year, every expiry and every strike, and I plotted them on a graph, this is basically what it's giving us. This is called the volatility surface. And on the bottom here, it's expressed in delta. Okay, we have delta on the bottom. So as we get further out in the wings, we call it, out in the wings here, it's lower delta. So these are way out of the money puts on this side and calls on the right. And right here in the middle would be 50 delta, right? So 50-50 each way. And if we could kind of spin it, we can see we can go here on the bottom, we go out in time. And then you see the volatility on this left-hand graph. And you can just kind of move it around, look at it, and it's kind of funky like playing a video game. But basically, let's say the FOMC meeting comes out tomorrow. And right before the FOMC meeting, we might see this volatility surface be different. Maybe all of a sudden the puts start to get a lot of implied vol. This side starts to go up short term. That means the market is starting to lean that way. That they're thinking, hey, there's going to be some action on the puts, so they're pumping up the premium. Anybody who's selling them is going to want some more premium for them if they're selling them. So it gives us an indication of what the market is thinking. And of course, right after an event, let's say the FOMC comes out and it does push crypto down. Bitcoin goes down 3 or 4 or 5% or something. Well, we're going to see that expressed here in this volatility surface. At least in the short term, we're going to see a big spike up. Right now, we can see this spike here short term. That's probably tomorrow's expiry. Let me just see if I can zoom. That'll be the earliest expiry. Oh, come on. Yeah. 230802. No. It's probably there. Yeah. Short term, high gamma. We do get those spikes at the front of the volatility surface because, it's going to be high gamma, right? But that's how to read the volatility surface. It's not, it's a bit of a leading indicator, and it's also a kind of a current indicator of what people are thinking. So it's handy to look at it every day. And it's going to change throughout the day as sentiment swings back and forth. This week, it's been doing squat. So as we see by the chart, because absolutely nothing is happening in crypto. Let's go back here. Okay, so were you, sorry, Gene says, were you always mostly selling options over your trading career or specifically the case for crypto options? No, selling options has been the mainstay of everything I've done for my entire career. And there are very few people I know who make their money off buying options. The people I do know who do it are more like day traders. They're sitting in front of their computer, kind of what I used to do on the equity side of prop firms, and they're typically trading those 0 days to expiration or near term expiry. Maybe it's expiring that week, but there's not a lot of time value built in those, and they're probably buying in the money or at the money options. But they're sitting there and they're technical analysts. They're waiting for signals and things to cross, and they're hammering in, and they're looking for those gains. But they have very disciplined approaches. So, for example, they have extremely tight stop losses, as you can, just like if you're trading futures, if you're scalping futures, right? You should be able to be wrong 5, 6, 7, 8 times in a row. And that's not going to wipe you out, because your one winner is going to offset gains, because your wins have to be so much bigger than your gains in order to survive in that game. And most people don't survive in that game because they let their losers run, or they take too many losers and they cut their winners short. That's the big killer for most people in that game. Hang on. Richard's trying to join, but he doesn't have the link. Just give me a second. And he should be joining us. Selling options is the way to go. And let's not forget, Delta, as one of its 4 primary uses, one of them is a probability tool. If I'm always selling a 20 Delta call, for example, that's my general strategy. Now, that strategy will change sometimes depending on market conditions. There might be juicy opportunities to sell a 40 Delta call, or I might be scared as heck and I might sell a 15, or I might not sell a call for some reason. Fine. But if I'm generally selling a 20 Delta call, that's the market saying that it has a 20% chance of expiring in the money. And as a call seller, I want to expire out of the money. So it means I have an 80% chance of being right. So it's a probability tool, 80% chance of being right. And the thing, you can manage puts just fine, but calls are a little bit easier to manage, at least in crypto. I've got no problem. If that goes against me, or now it's at my strike point, I've got no problem rolling it out. I have no problem rolling that out. And I'll kick the can down the road. If it's a weekly, I'll do it every week. If it's a monthly, I'll do it each month. So that's why I think, every single time, if you play with probability on your side. So let's say we look at the 20 Delta option, and we look at it for a year. Well, we might go 6 weeks where, oh my gosh, every time I sell this 20 Delta option, I'm kind of getting some pressure on me, or it's going against me. But if we spread that over an entire year, probability always works out. It's going to be almost spot on. That'll have an 80% probability of expiring out of the money over the course of a longer period of time. So you just got to play over time, manage it when it goes wrong, or do it as a spread. But selling options is definitely the way to make money. And I don't know too many professional traders in options who don't make their living by selling options. It's usually just the retail crowd that's buying. Okay. Let's see here. Lose on the short call in the 3 chart. Does gamma always have the same sign as a delta? I'm not sure what you mean, Luke, by that question. Yeah, sorry. If you could clarify for me, Luke, that would be great. I'd really appreciate that. Thank you. Oh, and I see Richard has joined us. Looking disheveled, no less.
I'm on such a terrible connection.
Oh no, that's terrible. That's terrible. Okay, so but I hear you. Okay. I don't know if everybody could chime in and let me know if you can hear Richard. Okay, Richard, can you say something? Can we hear you, Richard? Can you hear me? Hello? I'm assuming he's monkeying around with his stuff. Anyways, don't worry about it. Let's see some other questions here. Spreads on nothing. Q&A. Oh, there's a ton in the Q&A section. I was over in the chat side. Sorry, guys. Richard, can you hear me? No. Okay. So, Luke, is 0 day to expiration a feasible strategy? If yes, what are the best settings? I love 0 day to expiration trading. And you know why? It reminds me of the old days. I don't want to get nostalgic on everyone, but, I used to scalp equities for, over a year. My average holding time, the average amount of time I'd hold a position was 3.5 seconds. So it's like, bah, 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 get it out lightning fast. And that was sort of what we did all day long. It was fun, exciting. Clearly an old guy thing. Now I have gray hair because of it. So, but 0 day to expiration kind of takes me back there. You got that high gamma. When it goes, oh man, it goes for you. You get the opposite feeling of when you sold an option and the moment you sell it, you're horribly wrong and it goes against you. And you see how fast the price is moving against you. Well, you get to experience that going for you. So it's a wonderful thing. And I love it. But I wait for the right setup. Again, I'm not in front of my computer all day trading. I don't do that anymore. I'm creating content. I'm doing all that kinds of stuff. So I wait for those right opportunities. If I happen to be sitting there, no problem. I'll jump in. The thing with the 0 day to expiry or near-term expiry that you have to be aware of is if, let's say Bitcoin makes a big move down, you think there's going to be a retracement, even if it's a 20% or partial retracement, you have to buy that option at the money or close to the money or slightly in the money. If you think, it just moved down to 30,000 from 32, I'm going to buy the 32 call. Well, is it really going to go up to 32 before it expires? I mean, it might, but that's a long shot, right? So you want to buy in the money or at the money to let that gamma work for you. So it moves a little bit closer in parity with the underlying option. So that's sort of the secret there. Richard, are you with us? I can't hear you, man. I see your mouth. You've got a microphone problem. So, all right. So, what's the next question here? What is it? So, and just to clarify on that 0 day to expiration, Luke, the only way I trade that right now is if there's a big move. And it's not on a breakout. It's almost always a retracement that I'll do because I don't know if things going to break out. I can look at the Bitcoin chart right now and say, oh, it's ready to break out, and I'll buy a 0 day to expiration option. I can do that for 30 days and not make a cent. It doesn't make any sense, right? I'd rather buy a little bit longer dated and let it sit there. So what I'll do is I'll do the retracement. So a big move up, I'll buy some puts, hoping it'll retrace. And again, that Ethereum chart that we had.
Do you hear me now?
Oh yeah, I can hear you now, Richard.
Oh, okay.
Yep. Right. Yep. I'll just finish this up and then we'll hand over to you. But this Ethereum chart was lovely. We had a couple of those really big moves and a big move up. We had this big move up here and a nice retracement. Big move up, nice retracement. Big move up, nice retracement. It's a money-making machine. Of course, you have to get somewhere nearish the top. You don't have to be exactly on the top. But on this move, for example, up, you decided to buy the put here. Well, it wasn't done. My rule is, remember, 50% against me, I'm out. Well, I'm sure they would have been at 50% against me and I would have gotten out. I could have reloaded and tried again. And sometimes I do, sometimes I don't. But that's what I do. I'm a contrarian trader anyway, so I'm always looking for some amount of retracement, even if it's temporary. And those 0 DTEs are beautiful little money makers where you can sprinkle it in amongst all the Theta you're earning for the rest of the year. Even if you only do it a couple times a year, it's nice when you get a nice 200% return, or every now and then you might get 1,000% return or something crazy. That's always just a lovely little Christmas gift. So, Richard, so we're just reviewing my trades, talking about, we're going through some questions, but why don't I stop sharing the screen and welcome. So you're at the hotel, you got checked in. I don't know what the problem was, but are you okay with your internet connection or what?
I'm having to route through my phone via the mobile network because the hotel Wi-Fi have firewalled Webinar Jam and I presume other webcasting software.
Okay.
So,
okay. All right. Well, if you didn't have such a jet-setting lifestyle, this wouldn't be a problem. I'm just saying. If you just stay home more often, we'd be okay.
Yeah. Well, I do try. Yeah. So we're just covering. Sorry, I'm behind. I've just been in traffic. So are we just covering where we are in terms of the books?
Yeah, I just went through the trades I have on right now, and then I started answering questions. Well, because I knew you were just a few minutes away. So
Yeah. Okay. Thank you, everyone, for waiting. I appreciate that. My book hasn't changed very much. I'm adding risk as and when vol gets to a level where I'm prepared to be paid it. So for me, I never allow myself to take a position that's less than 45 vol. Now we've currently got markets. Should I screen? Do I dare screen share because I'm on such an awful connection? We'll give it a go. Do we see my screen?
I do.
Yeah. Okay. So just looking at the historical vol, we're really low, and for about a week now, we've been low in the low 30s. Looking at the devol index, this is the implied volatility of the 1 month at the money when it loads. That's been around, I think, just under 40. There we go, just coming down to 40. So there's still volatility premium, but I really don't feel comfortable selling 40 vol options because you see the size of these spikes. We could easily spike up to 70. We've got the FOMC coming up soon. We're in thin markets, slow markets, and it wouldn't take much for BlackRock or some other bad actor to come in and buy the market and make it a difficult day for me. So I'm just being very careful about what I'm selling. So I think this morning I sold some 10 delta calls, 7 day, 2 weeks, 1 month, and I sold a couple of 3 month. There's still about 50 vol out at 3 months and beyond. And out into 6 months and 9 months, the vol surface is skewed very much towards the calls. So I think you can get like 60 vol out in December if you dare. But that's
yeah, and I think we looked at the volatility surface just to interrupt. We were talking about it. We were saying, look, hey, next year out, we're at 70 vol, but oh boy, yeah, that could easily be a nightmare.
A year's a long time in crypto. So I've got a couple of positions rolling off tomorrow, I think. Let's have a look. 21st of July. I've got some worthless calls rolling off tomorrow, I think. Yeah, I sold all these at about 10 delta or 15 delta, maybe 20. And they're all worthless now.
That's funny because I was just talking about I clear my options out when they get below 10 delta, and you're selling them. So we have two different styles, as everybody who regularly follows us.
Yeah. Knows. So I wouldn't sell low delta calls if I didn't have a robot auto hedging me, because the gamma can get big really quickly, and you're picking up. I've said it before. It's like picking up pennies in front of a steamroller or a road roller, and one trip and you're going to get crushed. So not a job for the faint-hearted, but I see value there. A little bit of value there at the moment. So I'm just picking it up. And then further out, you can be a bit more avant-garde. So we're currently, the 25th of August is currently the 1 month, isn't it? So I've got a bit of residual stuff. I'm actually long gamma a little bit there near the money, and then selling a bit further out of the money. I've got some short puts which I sold in a moment of madness, but they're okay. They're bleeding value nicely. And I think I'm just being extremely cautious, just waiting for a big move either way before I do much at this stage. Probably much like you. I mean, I'm trading systematically, but I am being, just cautious not to allow myself to be sucked into a trade when I don't want it. In fact, yesterday I had 6 trades lined up I wanted to do, but I only did 2 of them because the vols just weren't there. I did them today instead. Vols have spiked a bit today. I haven't checked the economic calendar actually to see whether there's anything coming up.
Patience is key. Yeah, no, we got the FOMC next week. There is a number today, but I think it's unemployment. I can't remember what it was, but it wasn't a big number. I don't think so.
UK retail sales today, which is irrelevant. They've got the Fed next week. That's the big one. So I would imagine we're probably seeing a minor. I think we saw a minor vol spike in Ethereum this morning. I was able to get more Ethereum positions away. I imagine that will continue until sort of tomorrow afternoon, and then vols are going to take another dive for the weekend, I would have thought. I'd be interested to see whether we can actually print some vols under 30, in which case, you know, Bitcoin and Ethereum are now safer than stock.
Yeah. Cool. All right. So, you know, please, if anybody has any questions, post them. We'll catch them at the end of the show. But Richard, why don't we just dive into the theme of today's call, and that's earning interest on your, our claim was that you can earn out like 9% interest, right? So, you know, double sort of what you're getting from the bank, and that's an interesting technique. So if you wouldn't mind just jumping straight in it, and we'll do questions right after.
Yeah, so the premise of the claim is that the future generally trades above the cash, at least in Bitcoin and Ethereum, and this is a situation called contango, and the opposite would be backwardation. The fact that the future trades above the cash is a function of the fact that you can earn interest on your dollars, long and short of it, and you can't earn very much interest on your Bitcoin. Plus, there's also the dynamic of, you know, people who tend to hold Bitcoin tend not to want to let go of it. There are fewer reasons to borrow Bitcoins, I guess, than there are to borrow dollars. The future is priced on the basis that you would be agnostic as to what, if you were being perfectly rational and you were doing the right thing and always getting enough interest on your cash, you should be agnostic about whether you own the future or own the cash and the claiming interest. So actually, I'll share my screen again just to illustrate this. So if I go to the futures, or I'll go back to the options screen, and then I hit this tab called futures, which Deribit have very helpfully put up for us. Oh, goodness me, look at that. So you can see that the mark price, for example, of the 21st of July future is 30,287. The perpetual is 30,285. And the underlying index is 30,270 or 269. So the tomorrow overnight future is actually trading at 8.15. What was that? $16 above the cash. Now that future tomorrow at 8 a.m. will settle at the cash. So there's $16. Just if you sold the future and owned the cash, or i.e. sold the future and owned the Bitcoin, then you are actually going to receive $16 of premium tomorrow, which actually Deribit's computing is actually worth 31% annualized. Now bear in mind, this is a tiny amount of money that you're earning. It's $15 on $30,000, so whatever that is, half a basis point. But if you were to annualize that half basis point, it comes to, if you and tot it up over the days, it comes to 30% interest. Now, there are caveats, of course, otherwise everyone would be doing this. The trick is you've got to, of course, buy the Bitcoins and sell the future at prices where the trading fees and the spreads are not going to destroy the half a basis points that you're just winning, which necessarily means that on Deribit, as a retail client, I think you're paying, I forget whether it's 3, 4, or 5 basis points as a taker on the perpetual, but as a maker, you're paying 0 in terms of trading fees. And as a maker on the 1 week future or the 2 week future, I think they'll actually pay you a basis point to when you get made. So you actually you pay negative fees by being a market maker on the 1 week and 2 week futures, even if you're a retail client. So that means that if we were careful, we could gently move into a trade where we, for example, buy some spot, or even own the perpetual, and then we sell. We get moved into a trade where we sell the short-dated future, and then tomorrow morning, when settlement occurs, we will pick up that realized profit. Now, of course, there's a few things here that could go wrong. The settlement price of the future is the average price over the half an hour prior to expiry. So starting at 0730 GMT and ending at 0800 GMT, the price is sampled every minute, and effectively 1/30th of your futures position expires every minute in that half an hour. Which, of course, if you're short, just 0.1 Bitcoin or less, hedging out of that and going into the next, rolling into the next future could be lots and lots of little micro trades. If you're a bigger account, then you might want to do it in bigger chunks. And I think all of that is saying, well, look, there is all this lots of value. We're at 40% now in terms of premium on this overnight option, this future rather. But getting into it and out of it is going to be a bit tricky. So let's look at another week beyond. Look at the 28th of July, which is 7 days and a bit, and that is currently annualizing 9.22%. Which actually, so we've got like a few days to get into that position. We could be careful about the way we market made on the cash market, either spot market, and on the futures market. And by the way, the Deribit spot market. So there's good reason to be there if you can nudge yourself into position, and if you're patient.
Richard, sorry to interrupt. Just so you know, yeah. you kind of lost audio there when you started talking about the spot market. Can you repeat that, please?
Sorry, yeah. So the Deribit spot market has 0 fees for makers and takers. So if you owned, for example, USDC, you could theoretically place an order in the spot market to buy the BTC, converting your USDC to BTC, and then you could have simultaneously place an order to sell the 1 week future, the 28th of July future. And on the spot market, you can be a taker, it doesn't matter. And on the future, because you're going to pay 0 fees, and on the futures market, you could be a maker and just time it so that you get put into position. And then over the next week, you're earning, in this, well, at the moment, 7.92% on that money over the week. Now, as we said, that future will settle at expiry, and that's when you're going to realize your profit. Of course, if the expectations of the market change in the meantime and the future starts trading in backwardation to the cash, then of course you can pick up your profit much sooner. But in the last hour prior to expiry, we tend to find that just prior to expiry, the future and the cash start trading at the same price, and so that's when you can. So what you could then do is roll out of the future, buy your futures back, and resell the next week's future, in order to keep on rolling that position. And this of course is a classic basis trade. Now, last week, I think when we proposed this topic, the implied interest rate was about 10 or more %, and I've seen the implied interest rate up as high as 15-20% on these futures when there's strong demand for them. So if you're prepared to be diligent and patient, you can wait for the rallies where people are keen to buy futures because they need to hedge their options positions, and you can just slot into these trades and actually pick up the basis trade, and essentially, with all of the caveats that I've mentioned in terms of execution risk and making sure you don't pay the bigger fees, you can actually earn a return on your USDC by being long the Bitcoin and short the future. And just in case that all sounds like too much work, you can accept a lower interest rate. So, for example, on the 6-month future, you see the 29th of December, that's trading at 31,060, while the cash is trading at 30,220 odd. So you could actually get into that trade with huge margin of error and earn yourself 6.2% annualized over the next 6 months on your USDC. And that would be the easy way to do it. Or you could even go further, go a year out and earn 5.7%. So just for comparison, on my US dollars in my Swiss bank, I'm getting 4.3% on my dollars at the moment with a it's a 1 month callable loan. So I have to give a month's notice if I want the money out. So I can actually earn more money on my USDC on Deribit than I can in my Swiss bank. Even doing it the easy way, trading once a year.
Yeah, very cool. And I think that's the one thing that people are like, oh my gosh, to earn the highest rate, I need to be doing this daily or weekly. But you don't really, you can take a little less and do it once a month, sell the monthly or do it 6 months. Yeah. But the trick is rolling it. As you said, you've got a half hour where every minute, 1/30 of your position gets unwound. So I think you're best off to unwind your current short, buy it back prior to expiry, just prior to expiry, and then selling the new one. Would that be accurate?
Yeah. So we find that these, well, you can see that this price is actually quite sticky. So it's currently at 26%. That's because the overnight future is kind of almost being held at an artificially high level, just by virtue of perhaps the difficulty of trading it, the demand for it. Maybe nobody wants to buy at that price because they see the spread and they don't want to pay the 27% annualized to earn that future. And what we find is that price will stay sticky until about an hour or two before expiry, and that's when to act in general. Or you could wing it and let it expire, and then hope the market doesn't move through expiry. It tends not to, by the way, but you could then roll after expiry if you. But then you're into you'd be long the underlying, so you'll enjoy a 50-50 as to whether you gain or lose.
Okay. Yeah. Cool. Yeah. So if anyone has any questions, sorry, go ahead.
Yeah, and I was going to say it's worth also mentioning, and I think I mentioned it the last time we did this talk. If you look at the futures price, so I'm going to show you the 1 month. Sorry, the options price. I'm going to show you the 1 month option. If you look at you see this bar here where it says the date, how many days to go, it's monthly, and so on. If you look over on the right hand side, you can actually see they show you the synthetic future. Well, if there is a future for that date, they'll show you the actual futures price. If there isn't a future for that date, they'll interpolate between futures and show you a synthetic futures price. And you'll see that price, that 30,418 for 1 month hence, is again higher than the BTC price of 30,233. And these options, like all options, are effectively priced off the future, not off the spot price. And again, that's because if people are going to own the underlying, they're going to demand compensation in terms of interest. So that's why the futures trading in contango, and so the option is priced off the future. And you can generally see that if you're quite close to the money, 30k, you can sometimes not today because we're too far apart. Sometimes you can see that even though an option's at the money, it's not 50 delta. And that's because it's actually slightly in the money against the synthetic future. And so that inherent interest rate is also a component of the prices of calls and puts. And while the market's in contango, as it is now, you will receive a little less premium or pay a little less premium for your puts than you will for your equivalent calls for the equivalent implied volatility because of that rate differential. So in actual fact, you can pick up that interest rate just by, for example, selling calls maybe at, I don't know, 20 or 30 delta and then continuously hedging them or rolling them if they get in the money, you're still actually benefiting from that implied interest rate. And it's all adding a little bit to your bottom line.
Very cool. So again, if anyone has any questions about how to earn interest using Deribit and by selling these futures, let us know and we'll answer those. So Richard, just before you came in, we were right in the middle of asking a few questions. So let me just go through and because you don't know which ones we're answering, which ones are not, we'll clean up some of those and then we'll come back to the questions regarding what you just said. Luke had asked if delta negative then gamma negative. No, usually as option sellers, we're often, gamma negative because we're always selling, right? But if I buy a put, I'm going to be positive gamma. So if I was very concerned about the market breaking out of this range, I could buy calls and puts, a strangle or a straddle or something. I'd be positive gamma, and that's what you're doing. You're with that type of trade, you're looking for the market to move, right?
Sorry, that question to me.
No. I just thought if you had anything you wanted to mention about that.
Yeah. Actually, so a trade I often do is actually selling risk reversals. If I don't know which way the market's going to go, on the basis that if it goes down, it could go down really, really hard, and so I want to get long gamma if it's going to sell off. And so I'll actually sell calls and buy puts. And I particularly like doing that when the risk reversals are positive, i.e. puts are trading more expensively calls are trading more expensively than puts. It's a nice trade because I can sell, I don't know, like a 10 or 20 delta call and buy a 10 or 20 delta put, or a 30 delta call and put. I'll get a little bit more premium for my call, or I might sell 2 calls and buy 1 put, or something like that. And I'll do this actually just little and often, a little bit every day. I'll just pick up this trade, and I'll use futures to hedge the calls to make sure that they don't get too expensive. And actually, I'm then set up to win in a couple of ways. If the market starts to feel like it's going to sell off, you'll often find that the skew, the risk reversals of the market will actually reverse. So you might suddenly get a negative skew. And that means my puts will go up in price and my calls will go down in price, even though I didn't, the market didn't move. So that allows me to get out of that risk reversal profit, even if the market didn't move. All I'm doing is just trading the skew. And of course, if there is a sell-off, then the market's going to fall into my net of long puts, and they're going to increase in price. I'm going to get long gamma quickly, and because if you get a hard sell-off, the volatility of the market's going to rise, and so I'm going to get a big increase in the price of my puts, which are getting closer to the money, so that they're worth even more anyway. Meanwhile, my calls are way away and sort of vanishing in value. So again, I win. And then I've got the opportunity to say, well, do I now sell these at this massive profit and then go redeploy risk elsewhere, or do I actually buy futures to hedge the gamma, or do I buy calls to, I've got a bunch of options I can do. And for me, it's a very helpful trade because I need to make money consistently for clients and investors. And if I was trading for myself, I'd be happy to run a losing position for a month or two. I wouldn't care because I knew it would come good. But clients and investors tend not to feel the same way about that. It's often nice to have a structure which is going to insulate them from the worst of a sudden reversal in the market. Mm-hmm. And so, yeah, the risk reversals are a nice way to do that.
Okay, cool. Yeah, you do sell a lot of them, for sure. Mariano asks, do you choose selling options by some variable price, IV spread? So, well, Richard, he'll talk about what he does, but a lot of times what I'll do is I'm just looking for an opportunity. If I see something get overextended, I'm contrarian. I'm going to sell it. Whether I sell a 20, 30, 40 delta, and I'm often looking at delta, will just depend on the size of the move and the technicals. If it's coming up against support or resistance, no problem selling on the other side of that. Again, the skew can have a nice component. You know, maybe I normally sell a 30 delta, but oh my gosh, it's so skewed. The 20 delta is giving me lots of cash. I'll sell the 20. It really depends on the situation for me. So that's how I look at it. I'm more of an opportunist trader, and if I set it up as a spread, then I know I have limited risk. Whereas Richard mostly looks at IV.
Yeah, is that my cue? Yeah, so I'm much more systematic than Shane. So we look at backtest data and we look at the relative value in the vol surface, and that very much tells us what we're going to buy or sell. And we look for areas of the vol surface that we feel are locally under or overpriced with respect to the rest of the surface and with respect to the wider market. But in general, I'm a big fan of trading the smile. So if there's a strong smile in the market, I'm very keen to sell near the wings, maybe 20 to 10 delta area, on the basis that even if the market's going to move up into my calls or down into my puts, I'm actually happy because I'm hedging that smile with my futures. So I'm actually picking up not only the premium but also I'm picking up the smile. I might find that if the gap in money is a 50 vol and the 20 deltas are, I don't know, 65 vol, then as the market moves towards my 20 deltas, they become 50 deltas. They'll move down to 50 vol, and I've picked up 15 vols of premium or pricing power. Meanwhile, my futures have been hedging the smile as well. So I've made money on my futures, and I've picked up all that relative value out of those wings. Not a trade for people who only want to look at their book, once a week, but it definitely works for us in a systematic way.
I'll mention this. Ran Mordecai, you put your hand up to speak, but we don't have the ability to have more than 2 presenters on. So if you have a question, could you just put it into the chat, please? Question from Luke. Last week, you talked about theta to gamma ratio as a guide to enter into a position. How does this concept fit the IV decision framework?
They're complementary. So the theta that you're going to get, the physical, the amount of theta you're going to get for a position is going to depend on the volatility and the time to run. And the moneyness, and the gamma is going to be very closely related to it. But you do find that there are differences in the vol surface. When I was looking at this a couple of weeks ago, I was seeing a higher theta to gamma ratio in 1 and 2 weeks, and higher out more towards 6 months than I was around 3 weeks to a month. And so that was telling me that actually, in terms of average, multi-hedger is going to have to work a lot less hard if I sell the 1 week or 2 weeks or the 6 months relatively than it would if I sold the 1 month, for example. You can't take this to the extremes though, because if you just run an algorithm to scan the entire vol surface and pick off all the options, like the top 10 options that have the highest theta to gamma ratio, what you'll find is it'll pick up all the 1 deltas that are worth nothing, but they've still got a massive ratio of theta to gamma. So you've got to apply some sort of common sense to it. So I tend not to want to sell anything less than a 10 delta if I can, because there just isn't enough premium to warrant the risk. I'm wary about selling 10 deltas unless I can get what I think is good value. And IV in the current market, so we're realizing 32 vol. I think that's a very local low, and I suspect it's probably about as low as it's ever going to get. And I think I personally feel if I were to sell vol here, I'm setting myself up to be seen as a fool. So I have a personal limit that I won't sell vol for less than 45. And even if I want a position, like this morning I was selling, I think, some 20 or 30 delta calls somewhere. I couldn't get the 45 vol, so I actually just put a an offering 45 vol just to sit and wait. And actually, in the end, I got filled. But I'm prepared to be patient in this market. I do not want to be rushing into a war I don't want to fight. That's how it feels it's going to be.
So I don't know if you can hear that crazy noise.
What is that?
It's someone doing something somewhere in the building, and it's just turned on now. So it's beautiful, beautiful timing. So I might, if it keeps doing it, I might just kind of go quiet. But Luke has another question. On top of being delta neutral, do you also get gamma neutral? I'd say absolutely yes. Sometimes, I mean, if we're unsure about something, you know, it sucks to be negative gamma and have the market make a big move, and really, it can really hurt. And in fact, you know, we've had this conversation privately many times where we talked about different strategies, different ways to protect yourselves. And we have a friend who is a former floor trader, options floor trader. His mantra was every night he went home, he was gamma positive because he doesn't know what's going to happen. You wake up tomorrow morning, the market could have a big gap up or down, and he could really get stung. And I was like, well, hang on. If he makes his living by selling options, which is inherently gamma negative, how do you stay gamma positive, right? So, and that's there's a bit of trick in there. But yes, absolutely. If you're unsure or you think there's going to be a breakout, then you want to have a low negative gamma or neutral or positive if possible.
And just to quickly add to that, because I'm aware I do ramble on a bit when I speak. It's a function of getting old. Because there is this difference in this ratio of theta to gamma in different parts of the vol surface, and that moves around through the day and through the week. It is actually possible, if you monitor it carefully and you keep a good memory, it's actually possible to just carefully manipulate what you buy and sell in order to get yourself where you're actually theta positive and gamma neutral, which is an extremely happy place to be, because it means you're earning money for free. So it is possible, but it requires some finesse, patience. Yeah.
Okay, let me find the next question with that one. How often is your P&L up in a short CS, so call spread, that hasn't initially worked? So Tom, so if you're saying, does my P&L go up in a short that hasn't initially? Oh, so basically, yeah, if I put it on in the position, the underlying kind of goes up against me, I'd say most of the time it ends up paying me, because probability was still on my side. Like, I didn't get my exact timed entry. As long as it doesn't breach my short strike, which would cause me to roll or close or whatever I wanted to do, I'd probably roll it. Then Theta is working for me every single day. Let's say I sold it a week out. And over the next 2 days, it kind of crept up and got closer and closer, but I just held tight. And, every day, as long as it doesn't go through that short strike, that option is going to expire at 0 at the end of the week. So it still quite often will work out for me. Worst case scenario, I'll have to manage the trade and roll it. Or I'll just take the hit, which doesn't usually happen very often, because I know it's a limited risk hit because I have the long option, but I'd probably prefer to roll it generally. Question from Dom: is there usually a better time of day to put trades on when the US or EU are trading? I'm guessing.
Yes, absolutely. Yeah. We've seen this really strongly in the past 3 months. Basically, don't sell anything until the US is awake. It used to be that Asia was quite busy, but I don't see much action overnight on the Asian times. At the moment. So sometimes you see some big moves in Asia, even on a Sunday. I'm not seeing those at the moment. So I'm very reluctant to push to get into position at least until my 3 or 4 p.m. when the US starts to wake up. That's when all the action's happening right now. Yeah.
Okay. Why is, Luke, again, why is historical vol always below devol? Over time, devol revert to historical vol, right? That's a good question.
That's a great question. There are probably all kinds of reasons for that. The market can probably sustain having a difference in the vols for an extended period. for all kinds of reasons, but one of them that springs to mind is the fee structures on exchanges. So there are some very important firms who trade on exchanges such as Deribit, and called market makers, and they're like the bookmakers of the horse racing track world, and they get kind of special privileges. They get to trade at better fee levels than the rest of us, and that's because it's very important for us and very important for the exchange that these guys are there, and prices, tight prices either side of the mid, and so the biggest and best of these market makers will actually get paid for making a market and getting filled, and so they can do this on options. They can get paid to get filled on options, and at the same time they can get paid to hedge those options by market making the future. So actually, if for example, the daily vol or the monthly vol is low, i.e. the market's ranging, but the intraday vol is still reasonably high, that market maker could feasibly make money or even break even if he's long an option that you sold to him. He got paid for that, and then he's going to get paid to hedge that option by being a market maker around the spot or the perpetual. And it's quite possible that he gets paid enough to cover the difference between the vol of that option and the realized vol of that position and the implied vol that he paid. So I don't think they always converge. I think there are forces in the market that work to everyone's favor. But yeah, if you see realized vol stay low in the low 30s for a while, you're starting to see it now. The vol in the market will start to come down. I mean, I'm seeing at the money vols in the 1 week and 2 week. This morning I saw them at, I don't know, 38 vol, 37, getting closer and closer to realized vol.
Okay.
Yeah.
Another question there from Luke. He said, do you partially close a hedging position to get delta neutral, even if it's at a loss?
Yes, I do. I'm on the whole a seller of volatilities, and therefore I'm always short gamma. So I'm getting paid to get into a position, and then I'm fighting to not pay to get out. So pretty much the same as Shane.
Yeah.
But I hedge regularly. Actually, periodically. So I do about 25 hedging trades a day on my book. And those are always at a loss. Well, there's a few exceptions, actually. If there's been a big movement in the risk reversals, i.e. the skew has changed radically during the day, then actually, even if the market hasn't moved, my delta will move, and therefore I will trade. Now, I trade as a maker, not a taker, because I'm super conservative about saving fees, particularly in the current markets when the vols and spreads are small. But about 90% of my hedging trades are loss making, and the art of my game is to get enough premium for the option that hedging it doesn't cost you quite that much. So I'm kind of trying to get an arbitrage between the realized and the implied vols. That's my game.
All right. A couple of questions from John about what you're talking about. So in a bear backwardation market, how do you put on a reverse basis trade?
I will struggle mentally with this. So if the future is trading below the cash, then you would buy the future and sell the cash. Now, selling the cash, not so easy. You'd have to go and borrow it somewhere. Or you could sell the perpetual if there's a difference in the rates. So we do often see a difference in the rates. So the perpetual might be trading at, I don't know, theoretically it should on average pay the base rate or the lending rate, but often doesn't. So you might be able to sell the perpetual at an advantageous price and buy the future. Often you'll see discrepancies between the dated futures and the perpetual, and you'll see discrepancies between the dated futures and dated futures because traders need to match their deltas. If they're delta neutral traders, they need to match their deltas on expiries, otherwise they've got basis risk. So there can be market pressure to move the futures around and put them out of line. So you could also get this kind of interest rate differential between different futures as well.
His second question from John again is, how do you deal with the opportunity cost of a carry position? So if you tie up your spot BTC as part of a carry position, it's not realizing the upside in the bull market where the carry ops are large, the returns of the spot are even larger.
Yeah, this is kind of the question. The fundamental question is: am I better off playing around in the futures and options markets, or am I better off just holding my underlying in the firm belief that it's going to the moon? Right. If you are firmly of the view that Bitcoin is going to the moon, then doing anything other than buying futures or buying calls is, or actually buying risk reversals, right? That's probably what I'd do. That anything else would be a dumb trade. If you're right and you know you're right, then obviously you just go long as balls, right? But
yeah, you could do you could do a Texas hedge. You could own the underlying, you could sell the puts and buy the calls. right. Well, and that's your risk reversal too.
Yeah, it's a risk reversal on top of risk. And I'm fully aware, and I'm very happy that half the market sees owning Bitcoin as an asset, and the other half of the market sees owning Bitcoin as a risk. In actual fact, I run a couple of books. One of those books is around using options to increase the number of Bitcoin that's on the book, because that's for customers who believe in Bitcoin and want more Bitcoins and don't have the access to, for example, mining, or believe I can give them more Bitcoins than mining will. And there's another book I run which is about increasing the dollar value. And so the Bitcoin book is very simple. You just own Bitcoin, sell options, hedge the residual delta, and it's all very easy. And if Bitcoin halves or doubles in value, you don't care because you've still made Bitcoins for your customers, and everyone's happy. The dollar book is a bit different because you now need to hedge the value of Bitcoin dropping, so hence the risk reversals in my book and the continuous hedging. But you also live under the sword of Damocles, because if you get a sudden rally in Bitcoin, for example, the recent 25% that we had, or whatever it was, people are very short-sighted in the results that they see, and if they come to your book and your book has maybe lost 1% or 2% in that same period as Bitcoin's risen by 25%, they'll say, "You're an idiot. I should have just owned Bitcoin," right? And they will forget all the times you protected them when Bitcoin halved. So there's so I'm well aware of this sort of question, because it's a question that even the customers who want to accrue dollars will ask me if they haven't accrued Bitcoin.
All right, that's the questions for today. Richard, any final thoughts on what you think might happen for next week's FOMC? That was our poll question. Most people think it's going sideways. About 70% think it's going to go sideways, 20% up, 10% down. So most people think nothing's going to happen. What do you think?
I think we've got to imagine that the people who matter in Bitcoin are all whales, right? And right now they're just selling themselves on their yachts in Caribbean islands and surrounding themselves with beautiful young women and partying. So I reckon they don't care. So it seems to me that, on the basis of human nature, there's going to be no drivers to move the market around. I mean, and all the guys at BlackRock and all those guys, they're now about to go on holiday, and the last thing they want to be worried about is getting on the phone and moving markets around when they're in southern Italy, Florence, enjoying great food and weather and all the rest of it. So I think until everyone comes back to work in September to mix things up, I think it's very likely that we go sideways or drift down. Probably. I'm always a bit bearish, by the way, because I see Bitcoin as a risk. I'm well aware that at least half of you will see it the other way, but
So here's an idea then.
It'd be great to do an episode actually where people challenge me as to why I see Bitcoin as a risk, because that would be a very interesting conversation. Right?
People might get very passionate about their Bitcoin. So here's a trade idea. If you think the things are going to continue sideways, could you sell like an iron condor or something? Yes, you could. That's the classic thing to do. But there might be an opportunity to take advantage of volatility crush here. So maybe don't put that trade on right now. Wait until just before the FOMC meeting. If we see any rise in vol, people are like, well, FOMC is happening, and vol start to rise. That's when you might want to sell it. I'm not saying you should. That's a strategy. People do this before earnings on stocks, right? They'll do the same type of a thing. They'll sell in anticipation that there's not going to be too much of movement, because right after the news comes out, the earnings or FOMC, and all that's disseminated, if there's nothing happening, those vols collapse. That's called the vol crush. You could do that. That's something I'll be looking at. So maybe if we do get a bit of a rise on vol. Now, before the last FOMC, I didn't really see much of a rise. It didn't seem like the market was really too interested, but it could be interesting to do this time. So a little trade idea for some people there. Oh, there was one other question. Sorry, and I missed it. It was from Gene. Have you started to sell 40 deltas as shown by your backtest results? Now, remember, for people, we had some backtest results where it was showing we were selling the weekly calls. 40 delta ended up being the best results over the course of, I think it was for 1 year. Now, the qualifier there is that this was just backtest data, and those positions weren't managed. So basically, we're saying, okay, we're going to take the week, we're going to sell it, we're going to let it run to expiry, whether it's against us or not, or in the money or not. Now, under normal conditions, we'd probably manage that trade. So we need to do another test to show those modified results. But that was our baseline test. So, Richard.
We should start about doing this. I've been too busy in my day job to worry about it. But we have mentioned it as part of the Road Traders, haven't we? We'll be doing a thing quite soon, like a featured trade thing. And actually, one of the trades we do, we could run a book like that and see how well it does.
That would be very interesting. Yeah.
It's not a bad trade. I think. I think the risk of the risk of it running away with us at the moment, it's probably quite a good trade. I think they're selling 40 calls now, 1 week calls. Manage it, yeah, why not?
Because the popular sentiment in the world over the last 2 decades, you watch trading programs, you listen to gurus and stuff, they're selling, 52 days out, and they're selling, 20, 25 deltas. That's their sweet spot. But so when our results came in, that was selling the weekly, and a high of 40 delta was where the money was. I think we were both a little bit surprised by that.
Yeah, and I think now would be one of the times where that pays off. At least until vol comes back. Okay. I just wanted to add that all of my blathering earlier about market going nowhere, of course I could be totally wrong, and we could be back up to 60 vol next week, and that's why I'm being very, very cautious in my trading. I'm not going all in on iron condors now. I also wanted to mention that you were talking about if you get into a short call spread to the wrong price. Do you remember that we did an episode on how to hedge with futures and how to hedge early? If you're into a call spread and actually it's in danger of getting near the money, then you can always buy some futures. You can always buy half as many futures as you've got calls, for example. And then once your calls are at the money, what you are actually into is a synthetic straddle. So you're effectively short puts and calls. There's all kinds of stuff you can do with futures there. Mm-hmm. And then with the opportunity cost of the carry position, I just wanted to add one more thing. That is, I at the moment, if I sell calls, I am currently not hedging those calls with dated futures because the interest rate is nice and high. I'm actually allowing myself to hedge those positions with cash, and if I run out of delta, I actually buy perpetuals at the moment. So I'm actually going long perpetuals. I normally wouldn't do it. I normally hate being long perpetuals, but at the moment they are slightly cheaper than the 1 week and 2 week futures. So yeah, that's something I'm taking into consideration. So I think that implied interest rate is something to bear in mind, not always something to trade. But I think John's right. There are often better opportunities than the carry trade. But what you can do with the carry trade, of course, is leverage it quite nicely. Just beware that the carry spread can get bigger as well as smaller. So in the long run, you'll always make money, but in the short run, you could get blown up if you're too highly leveraged, and that's true of all trading, all arbitrages, and also true of the argument it looks like I'm about to have with Tom over whether Bitcoin's an asset or not. Because I think it probably is long term, but the short term can kill you, right?
Yeah. And some people will just segregate their accounts too. They'll just take 10% and they'll say, hey, this is for carry trade, and we'll see how it performs over a year. You're going to earn X amount or close to, depending on the execution. And so you can have the best of both worlds and do them both. There's nothing wrong with diversifying a little bit. Okay, I think that's it. We went much longer today. We had a bit of a delay with Richard and his excellent adventures in Barcelona.
One from Lewis. Yeah, sorry guys, I forgot about that. There was the traffic out on Andorra was terrible. Okay. When you do the BTC coupled call, do you take into the spot balance? It depends on whether I'm trading to accumulate Bitcoins or trading to accumulate dollars. If I'm trading to accumulate dollars, what I'll do is dump a bunch of Bitcoin in the Deribit account and then immediately sell perps to the same value. So that in effect, what I've got then is cash, is synthetic dollars on the Deribit account that are earning me interest, because the perp tends to trade a bit above the cash and pay a bit of carry. So yes, I do take it into account, but I take it into account more as a macro issue of whether I'm hedging into dollars or hedging into Bitcoins. And so that's the way to approach it. Just so you are aware, if you check in the position box, you check the net transaction delta checkbox. Your overall delta for Bitcoin will be 0 if you're hedged into Bitcoin properly, i.e. 0 delta on Bitcoin, and that is you're hoping to earn Bitcoins, not dollars. If you are hedging into dollars, your delta on, as reported by Deribit, will often be negative, almost equal to your equity. There'll be a small difference because of unrealized intrinsic values, but Deribit will always report you as being short if you're actually delta 0 in dollars. Confused? You will be. Stick around.
I do think that was the last question. I don't see anything else coming in. So yeah. Again, apologize. We went a little bit late, but hey, lots of good info here. We covered lots of stuff. Some great questions. Keep them coming. So until next week, have a great weekend, and hopefully the FOMC is kind to everyone. We make lots of money. Catch you later.
Thanks.